Good morning. This is Dan Lindblade, President and CEO of the Greater Fort Lauderdale Chamber of Commerce. Ladies and gentlemen, we're going to start the webinar in a few moments. Our agenda today is going to run approximately 1 hour with questions and answers. This session is being recorded and is privileged for the intended use of the South Florida Business Council and our invited guests. Anyone else should exit the platform. We welcome a number of elected officials with us today. Thank you for being part of the program. We have some prepared questions, but you also have the opportunity to ask by using the Q&A function, that feature within the webinar at the bottom of your screen. Our team will be monitoring those questions and presenting them to Dr. Bostic. As always, we could not bring this quality programming to you without the assistance of our support of our sponsors and partners. We're thrilled to have MBAF stepping up once again as our presenting sponsor for this webinar. Representing MBAF later in this broadcast will be Adam Spiegel as soon as he's able to plug into the system. But at this point in time, it gives me a great deal of pleasure to introduce to you the chairman of the South Florida Business Council, Jack Seiler, past mayor of the city of Fort Lauderdale, and partner with Seiler, Sauter, Zayden, Rhymes, and Walbrink. Jack, the floor is yours.
Hey, good morning, Dan, and thank you, and special thanks to MBAF for bringing this program forward. This is going to be a wonderful morning. Before I introduce Dr. Bostic, I wanted to share a little more about the South Florida Business Council. We created this council as a tri-county partnership committed to attacking the region's most critical issues. As the 12th largest economy by GDP in the country and the 38th largest economy in the world, we need to unite this region, utilize our substantial resources and influence, and focus our combined efforts on elevating South Florida. The Chamber of the Palm Beaches, the Greater Miami Chamber, and the Greater Fort Lauderdale Chamber represent the cornerstones of this unique collaborative. Our three extraordinary CEOs and our outstanding leadership team have set a course of action that is in the best interest of the entire region, our businesses, our families, and most importantly, our future. Now on to the program. Dr. Raphael Bostic took office June 5th, 2017 as the 15th president and chief executive officer of the Federal Reserve Bank of Atlanta. He is responsible for all the bank's activities, including monetary policy, bank supervision and regulation, and payment services. He was born in New York City, grew up in New Jersey, graduated from Harvard University in 1987 with a combined major in economics and psychology. Good time to have economics and psychology combined here, doctor. And earned his doctorate degree from Stanford University in economics. From 1995 to 2001, he worked at the Federal Reserve Board of Governors as an economist in the Monetary and Financial Studies section, where his work on the Community Reinvestment Act earned him a Special Achievement Award. He also served as Special Assistant to HUD's Assistant Secretary of Policy Development and Research and lectured at American University. From 2001 to 2009, he had an impressive run at the USC, where he was on the faculty there in numerous positions and also very involved in the business communities in Southern California. From 2009 to 2012, he was the Assistant Secretary for Policy Development and Research at the U.S. Department of Housing and Urban Development as the principal advisor to the Secretary on Policy and Research. He then returned to USC and chaired the Governance and Public Enterprise at their School of Public Policy, and then now has been appointed to the Federal Reserve. He has served on so many boards and advisory committees, but with his impressive resume and background, we could spend too much time on his career and not get the benefit of his wisdom and insight. So at this point, ladies and gentlemen, Dr. Raphael Bostic.
Well, thank you, Jack, for the introduction. I want to thank the South Florida Business Council for inviting me to come speak this morning. Jack, that's a gold dome up there on the wall, isn't it? I'm really appreciative you were willing to talk so much about the University of Southern California this morning, given your background. But seriously, it's really good to be here. I'm really pleased to be able to talk to the council this morning. And before I get too far into this, I also wanted to offer a thanks to the Fort Lauderdale Chamber. So Dan, you guys have been a great help to us. When we just started our outreach during this really turbulent and uncertain time, your economic council has been very helpful in giving us insights as to what's going on and how businesses are thinking about moving forward and experiencing this this crisis. So I wanted to thank you as well. It's really good to have partners like the Chamber and the Council to help us do our job better. Now, what I want to do first, just to level set everything, is just let you know everything I'm going to talk about now, everything I say are just my ideas. They're my views, and they don't necessarily reflect the views of the FOMC, the Open Markets Committee, the Board of Governors in DC, or basically anybody else at the Atlanta Fed. So, you know, I'm going to talk for myself and give you a sense of how I'm thinking about things. So what I thought I would do is really start by giving you some backdrop or background of where we started this crisis, then talk a fair amount about the response that we've had in terms of trying to provide relief and help businesses and families and governments and nonprofits really get through this with as little pain as possible. And then close with a few thoughts about moving forward, sort of the things I'm looking at and how I think about how we might get through this and what the other side might look like. So to start, I think it's really important just to recognize that the difficulties we're going through from an economic perspective are really different than any difficulties that we've seen from an economic perspective in our history. Now, usually when we have sort of an economic slowdown, there's been a buildup of excessive risk. We see fundamentals that used to be sound starting to break down because of risk-taking behavior, either on the family side or on the business side. And it's those things that lead to difficulties. Fortunately, or maybe unfortunately, this is really quite different. What we have here is a public health crisis, right? And the virus coming into our country has mandated or warranted a particular public health response. And it's the nature of that response that is triggering economic downturn and stress, right? So that social distancing, all those sorts of things, those are the things that are causing us to have to slow down. So it's really different in character than what we've seen, say, in the Great Recession or the Great Depression, or even other recessions that we've gone through. And that's something that I think we all need to keep in mind. Now, the social distancing requirement really has clear implications for the economy, and it's really going to provide and introduce a lot of stress for everyone. The first stress is clearly going to be cash flow for businesses and families, as certain large numbers or types of activities are not going to be able to be done because they require people to all come together and be in a room together. And once you have stress in cash flow, that can quickly turn to stresses in credit, because businesses and families, as they don't have incoming cash, they're going to turn to the credit markets to try to provide that support. We've seen a lot of evidence of that. And the important thing to just be mindful of, if everyone goes to the credit markets, then those credit markets might collapse as well. So there is this potential for a spillover, which is pretty significant. Now, the other piece to this that I think is really important is that the economy was working well before. We were in the midst of 11 years of growth. That's a historically long time period for growth. And the fundamentals were largely solid. You know, we, for the last several years, have done a lot of outreach. And one of the things we've been looking for are signs that those risks that I mentioned earlier were starting to build up to suggest that maybe the economic recovery and the robustness of the economy was not going to be able to be sustained. And to be honest, you know, we asked pretty pointed questions. We were not seeing signs of those sorts of risks building up. And so we were pretty confident. I would say I'm pretty confident that we would have been able to sustain that growth trajectory for quite some time. So given that, then that really helps to shape a strategy in my head for how we should be responding to this crisis. First of all, you have to deal with the public health aspects of it. But on the economic side, I think the goal then should be to try to keep the economy as close to how it was in that pre-virus period. Because if we can do that and preserve all those solid fundamentals, then the recovery can proceed at a solid pace and a solid timing, and we might be able to really see growth return to where it was before after not too long. So all the responses that have gone on have really been in response to stresses that we've seen in the marketplace, to signs that the typical ways that people and businesses transact and interact were starting to break down. Because the more of those breakdowns we see, the less likely it is that we can keep everyone as close to how they were in that pre-virus period. So from a Federal Reserve perspective, our purview is largely monetary policy and financial markets. So we have acted quite boldly and quite decisively in our response to the crisis. Very early on, as people started to see the virus getting into this country, we lowered our interest rates, our policy rate to effectively zero, sending a signal that we were going to have our policy stance be as stimulative as possible when the recovery emerged, and also create no uncertainty there. We wanted people to be absolutely clear on where we were. In addition, we started to see breakdowns in a number of financial markets, and because of that, we have been standing up facilities to provide liquidity and credit to make sure that those markets can function in a more normal, a less distressed way. So one market was basically the basic Fed funds market, the market that gets traded for us to implement policy. So one of the first facilities that we put out was one to primary dealers, who are the traders who manage our Fed funds market. We saw stresses in federal government bond markets. And so we stood up a facility for money market mutual funds, which is a market that is commonly used for government bonds. We've also stood up facilities for municipal bonds, and that's one that we've done more recently. I'll say a little bit more about that in a second, but we know that state and local governments are facing considerable stresses because the contraction of transactions means that you're not getting sales tax, income tax receipts may be delayed, and the delay of the federal income tax means that stuff that may flow down to the states may not be coming as well. So we know that there are stresses there. We want to try to keep that as whole, and so there are some lending facilities for that. We started to see stresses in corporate bond markets, and these are the markets that the big companies issue debt into. So that's a way for them to raise capital. So if they can't raise capital in their standard debt markets, then they're going to have to go to lines of credit, and pulling on those lines of credit can really put stresses on banks. And we wanted as much as possible to have financial market operations not lead to stresses in banks. So we provided a liquidity facility for those markets as well. And then we've also done some things in dollar swap markets, because many international contracts are traded in dollars. We wanted to make sure there was no uncertainty about the amount of liquidity there either. What I would say is, that's a lot of facilities. It's a large amount of activity. And I'm pleased to say that the evidence suggests that they've been largely successful. What we've seen are the risk spreads in these markets reduce. They're not down to full normal, but I don't think I really expected it to go to normal. But they've come down considerably, and now they're at levels where these markets can function and function with a fair degree of confidence. So that's important. So now that's on the financial market side, but we've not really stopped there. And we've announced facilities to provide liquidity for both the Paycheck Protection Program, and we've announced that we're going to stand up a Main Street lending facility, because we know that there are stresses not just in financial markets, but in the markets that are the purview of businesses. Many of them are basically like yours, that are really just trying to transact in a regular basis with consumers in a host of different areas. And so we have the PPP lending facility is operating now. There have been billions of dollars of liquidity that we've provided through that. And the idea there is that the banks that are doing loans through that, we want them to not feel like they are liquidity constrained because they are doing that lending. And so we're providing that extra support on the backside so that bank capital can be more fully deployed to provide capital and credit to markets across the country. And the Main Street program is really designed to try to help companies that are above that SBA 500 employee limit and make sure that that they too have the ability to get relief and to forbear as much as possible. Now, in addition to the stuff that we've done in terms of facilities, and let me just say one other thing on the facilities. During the Great Recession, we stood up, I think, 3 or 4 of the facilities that we've just rolled that I just announced. And it took us more than a year to do those things and get them structured and organized. In the last 8 weeks, or 2 months or so, we've stood up 9 facilities. And many of them are in areas that we've never operated before. So when I say we've been bold, we have been bold, right? So the municipal facility is not something we've done before. Getting into corporate debt markets is not something we've done before. But I think you've heard from the chair, and I would share his view, that in this context, it's really a whatever it takes scenario. So whatever we have in our arsenal, we're going to deploy to make sure that as much relief gets out into the marketplace as possible. Now, I wanted to say 2 other things that we've also done. So one is the Federal Reserve is very involved in payments and the payment system. So as a result of the crisis, we saw a dramatic increase in the demand for just cash dollars. And every dollar bill that goes into circulation goes through a Federal Reserve facility. And for a number of denominations, demand is up 25 to 30%. And so we've actually had to deploy our folks at a much higher level to make sure that those dollars are getting out into the economy. And I'm pleased to say that we've not heard very many reports of shortages of just bills, and that's been an important thing. And then the second thing I would just point out to you is that the economic impact payments, those $1,200 checks that are going to many American families, those are going through Federal Reserve rails. So for those who got direct deposit, the Atlanta Fed oversees that operation. And so the tens of millions of payments have gone through our rails. It's a really significant elevation of our engagement. And then as the checks go out and start to get cleared, those will be things that we also engage with. So we've been super busy in terms of this relief and trying to make sure that everybody who is eligible for relief can get access to it. And the third thing I would say is that we have been very engaged with our banking, the bank institutions that we oversee. And we've been, I think, trying very hard, and I've been trying to be very clear on the point that we want to send a single message. We want banks to make sure that their capital is deployed to maximum effect to provide support and relieve burden, reduce burden. And so we've really encouraged banks to maximize the amount that they lend, get as much as they can. We've changed some of the regulatory expectations on that. We've said very clearly that banks should work with their borrowers to modify loan terms to the extent that that's possible, to extend terms, to defer payments of principal and interest, just so that we all get through this without having damage happen that is lasting. And then moreover, one thing that we've tried to be clear on as well is that we will remember that these decisions were made during crisis times. And one thing I've heard from a lot of bankers is, yeah, you tell us what to do. It's okay to do these things. And then 9 months later, you complain that we did it, right? And so if we don't have confidence that you're gonna have that view, then we're not gonna do it. And so we've really stood up and tried to be as clear as possible that we understand this is a crisis time. We expect some bold and perhaps higher risk activity and more creative activity in response to the crisis, and we won't penalize you for that. And what I've heard from banks is they've appreciated that recognition, and every banker I've talked to has really said that they're going to do all they can. They're going to work as much as they possibly can with their customers, and even with folks who haven't been their customers moving forward. Now, that's a lot, and it's, we've been very active and very fast in terms of our action. I do want to just remind everyone that we're a central bank, right? And the central bank has constraints on the types of things that we can do. We can do lending, we can do bank regulation, we can do oversight, but there are other sorts of activities that are going to be required. So a full response to the crisis is really going to require fiscal participation as well. And I would tell you that, in my view, that the Congress has responded in a pretty dramatic way. There have been 4 waves of policy, trillions of dollars of funds introduced into the economy to provide relief. And they've really been broad-based to support businesses, to support families. I talked about the impact payments and forbearance. In businesses, I've talked about the Paycheck Protection Program and support for particular sectors. And then renters as well. So it's been across the board. Now, what I would say is these things have all been quite important. The question for us really is going to be, is it enough? And how are people working with it? Now, to answer that question is really our job for the next couple of weeks. If you think about the Paycheck Protection Program, those funds have really just been deployed in the last 3 or 4 weeks. So businesses are just starting to take those on and really understand the implications for what they can do. For the economic impact payments, those direct deposits, they have been going out over the last few weeks. The checks are still being printed and they're in the mail right now. So that full relief is not out there either. So in the next couple of weeks, what we're going to do with my team and across the Federal Reserve System is really ask the question of, how is this stuff mattering? Is it helping? What is it allowing you to do? And what is it allowing you to change in terms of your prospects for the next, or if it's not enough, what more might you need? What are other things that might be available? Now, I wanted to just pause here and just say one thing, just to give you a sense of how we've approached this at the Federal Reserve. We know that the data that we're seeing in terms of unemployment claims, in terms of the job losses and stuff, they're all backward looking. And it's really important that we understand what's happening in real time, because the stuff that you guys are going through and experiencing, the decisions you're making, they will reveal themselves, but maybe not for 3 or 4 weeks into the actual data. And we need to know these things now. So the Atlanta Fed has a regional economic information network. We have a team of regional executives whose job it is to usually to drive around and meet with people one-on-one. We've modified that in this crisis to make that phone calls, but really try to talk to as many people as possible. In South Florida, Karen Gilmore leads that group, and I'm sure many of you have had conversations with Karen. She's great. And what we've typically done is in a FOMC cycle, in that 6 to 8 week cycle, but between the meetings when we make decisions on interest rates, we'll talk to 60 to 100 different contacts. What we've done in the last couple of weeks, basically, is we're talking to 200 to 300 contacts a week. So we've really ramped this up to try to get as much information as we possibly can. I mentioned the Fort Lauderdale Chamber Economic Council. That's been one of the parties that we've really tried to engage with. And it's really allowed us to get good intelligence on what's happening in real time. Over the next couple of weeks, this is going to be particularly important as these relief packages flow through the economy, for us to understand how it's helping, how it's making a difference, and what it's allowing people to do. So I usually make this commercial. If you get a call from the Federal Reserve, please take it, talk to us, let us know what's working and how you're living and experiencing. It's really of even heightened importance in these times, because we really need to understand what's happening so that we can get the word out to policymakers. Now, there are things that we have the authority to do, and we're going to do those things based on the information we have. But a more important, or at least an equally important function for us, is to do the on-the-ground reconnaissance and then let policymakers know what things are happening, so that if the solution is not in our purview, the people who have that control can make decisions on how to act. And so we're going to continue to do that as we move forward. It's going to be an important thing. I wanted to just say a couple of things about looking ahead and what sorts of things I am thinking about moving forward. this is the question everyone's asking. What's the recovery going to look like? What is tomorrow going to bring? And I have to tell you, these are unprecedented times. We don't have models that are based on, we don't have experiences, a lot of experiences of what happens when a pandemic flows through an economy and how does that recover. And because we don't have that history, it's very difficult to have models that you can have any confidence on. And you can see just in the epidemiology models that are reported by the media, there are a huge variation in them, and they have very different predictions about what's going to happen. And moreover, they change almost on a daily basis. So as we get more information, those things will happen. So I can't tell you exactly what the recovery is going to look like. I will tell you a couple of things. The first is it will depend importantly on how the virus progresses through the population. If the spreads get controlled, if we get testing that people have confidence in, then we can turn our energy much more fully to economic recovery and response. And we'll be able to have businesses that are in public-facing types of sectors really start to be more robustly open in the ways that they were before. If that doesn't happen, if people don't have confidence, then it's probably less likely that we're going to see a super strong recovery, because a bunch of folks are just going to say, I'm going to wait on discretionary things to the extent possible. So the public health response is critically important. A second thing I'm going to look at, and we're going to ask questions about, is whether all the job losses that are being reported, all the unemployment claims and things, do they turn out to be temporary losses or permanent losses? And I can put this another way. Is it the case that the relief provides a real bridge for businesses and families that is enduring and high quality? Or is it partial and incomplete? To the extent that most of these losses are temporary and we get back to relying on those fundamentals that we had pre-virus, then I think the recovery can be quite strong. If, on the other hand, the job losses are a large number of them turn out to be in a more permanent space, then the recovery is going to be harder and slower. One other thing I would say in terms of this is, I know, and we've heard very clearly, that there's tremendous variation in how this has hit sectors of the economy and how it has hit geographies of the economy. So I'm in Georgia right now. If you look across the state, the prevalence of the virus is quite different in different places. Florida is the same. And if you think about sectors of the economy, some sectors have shut down considerably. You think about the arts, you think about bars and restaurants, and others, more service organizations and businesses. They've been able to move to a remote stance and pretty much keep getting their work done. To the extent that that variation exists, that's important. And the other thing I would say is that the virus, in terms of how it's hitting people and hitting populations, varies a lot. So the reports are pretty clear that the virus has hit African American communities much harder than others. And that might mean that recovery and response in those communities is going to be harder, right? So I'm expecting there'll be a great deal of variation in terms of what this recovery and response looks like. And we should be mindful about that as we think about what policies make sense. And then the third aspect is really about the reopening of the economy and how we do that. For me, I think is something that we really have to think about. And I do want to emphasize on this one, this is a very hard question. Right? And there's not a playbook for this. We've never seen things like this before. And so, we're going to have to rely on our leadership. And it's my hope that our leaders stay extremely thoughtful, understand the implications of things, consider the nuance, and enact policies that don't lead to new flare-ups of infection and death, because it's those flare-ups that will undermine confidence in a way that will make our recovery more difficult. So let me stop there. It was I think it was about 20, 25 minutes, and we can open it up for questions.
Well, let me tell you, Doctor, there is no shortage of questions coming in. And let me just remind people that we have that function. And it's, I think, one of the neat things about this morning's meeting is that we do have that function. So we're going to have some interaction. And Doctor, not surprisingly, the first question comes from the academic world, from Jennifer O'Flannery Anderson at Nova Southeastern University. And she's asked that when you say you are standing up a facility, what does that specifically mean? Number of staff, resources? She is trying to visualize and understand exactly what that means, and how long will those facilities remain?
So, when we stand up a facility, basically what we're doing is we're creating a pathway for authorities, for financial institutions to access our discount window and draw funds and borrow funds from it. And so if say the PPP program, you work through the SBA and the SBA says, okay, we're authorizing $50 million of loans. If you want to use our PPP loan facility, you call up the Federal Reserve Bank of the district or region where you are and say, I want to do this. We say, sure, send us some, like for example, I have a discount window team in Atlanta. Some of them have been targeted and tasked with working on this program. You call us, we would funnel you to them. They would tell you the requirements. If you fill those requirements, we would provide you liquidity. We would swap out the 50 billion of commitment or 50 million of commitment that you had with the SBA, and then you would be free. We would take that on. And so we've ramped up. So for our group, we've increased the staff by 300%, something like that, to make sure that we have enough people to meet whatever demand is out there. So it really is a new functionality with a new set of authorities that we've stood up for banks and actually non-banks that can access us. In terms of how long this will stand, it's going to stand up as long as it needs to. And we are not in any hurry to take these things down, but we're also not we don't have any desire to have these things just be up permanently. And this is an emergency situation. And the chair has said pretty clearly that as long as we think that there are risks associated with emergency, we're going to provide and keep the tools that we have to provide those levels of relief in place. So we're going to continue to monitor. I'll tell you, some of our financial market interventions to try to calm those down have been quite successful. So we're reducing our engagement there. We only want to provide the relief if it's needed. And if it's not needed, then we can turn our resources to other things to make sure that we're getting as much support out as possible.
Thank you. The next question is something, obviously, our sponsor this morning, MBAF, does a lot of financial consulting, accounting. I think this is a question they probably get, so we'll send this one over to you. It says, since the rollout of the PPP program, the SBA guidelines have contradicted previous guidelines, creating some confusion and concern at a time when stability is needed. Has the Fed offered any assistance to the SBA on the program implementation? And also, does the Fed support a 501c6 organization being eligible for the PPP funding? Doctor?
So what I'll say is this: the PPP is not our program, right? We are not authorized to run the program. We have conversations with the SBA as we hear things from businesses. So a number of businesses have called me, for example, talking about aspects of the PPP that they thought were working or not working, and we have forwarded those on. The 501c6 issue, I've heard this from many circles, and I can assure you that the SBA is aware of this as well. And we're going to let those policymakers make the decisions for their program. And one thing that we've really tried to do is be clear on what we control and what we don't. And if we don't control it, we try to make sure that we have relationships with those folks. But it's really up to them and the policymakers who design those programs to do that. And then we'll follow whatever the regulatory structure says that we need to.
Great. And by the way, that last question was from Bob Rorlach, who is the CEO of the Greater Tampa Chamber of Commerce. So I'm sure you'll have a follow-up to that when you're dealing with West Coast Florida.
I'll be ready for the call.
All right. Next up is a question from Alfred Sanchez, the outstanding CEO from the Greater Miami Chamber. It says, we've seen some predictions that say 30% of our small businesses will close and perhaps never reopen. Is that your view? And what would it mean to the U.S. economy and how would that impact the enormous debt we are amassing in response to the short-term issues? I can tell you the chambers are a little more optimistic, but can you answer Alfred's question?
Well, there are a couple of questions in there. First thing, let me start with the debt question. To me, and I say this is my view, if we wind up with a poor recovery or no recovery because we didn't put in enough resources of relief, that seems like a bad outcome to me. That, I'll worry about the debt after we have gotten past this and have an economy that's working. And so we're going to do whatever it takes to get to the other side and then figure out what to do in terms of dealing with the debt. And let's just be clear. I think that the stronger and more powerful the relief is, the stronger and more powerful the economy will be on the other side. And that means that the stronger and more powerfully it will be able to grow and sort of grow to support that debt. So I think the interest really needs to be in making sure that the relief today is as meaningful and as impactful as possible. In thinking about the small business community, look, small businesses are really, really, really important to the U.S. economy. And if we lose 30% of them, that's going to be a huge hit and a big, big challenge. So, my hope is that the relief is going to work, right? And one of the reasons we're going to be doing this outreach over the next several weeks is to understand that, because it's my hope that we lose as few small businesses as possible. And I'll just tell you, in terms of modeling and expectations, I don't have any models, right? We don't have any experience on this. I have a lot of forecasters in my building. There is a tremendous diversity of views among them. If you ask a forecaster what the set of possible outcomes are, they'll give you a wide range of them. And then if you ask them to assign probabilities to each of them, those probabilities are not going to vary that much across those different scenarios. So I think, I'm going to try as much as possible to be real-time aware. And if I see trends and if I see developments, take that on as information that is important for how we think about what recovery is going to look like.
Great, thank you. The next question comes in asking, are you aware if there are any considerations to lengthen the 8-week period to spend the PPP loan money, since a lot of business may not be back up and running by that time? Any thoughts on that, Doctor?
Yeah, I have not heard any conversations on that. That's an interesting point to raise. I would say I will bring that forward. We have some folks of my team who are on here. We'll make sure that the folks at the Fed who work closely with the folks in the SBA and Treasury are aware of this. But I really don't know about the state of those conversations at this point.
Great. And I'll tell you, Doctor, your comments are drawing a lot of very interesting questions, and the exchange is just outstanding. People are very concerned, but certainly I think you're addressing those concerns. Next question up is from Rob Cordarens. Rob has a large company down here called Advanced Roofing, does a lot of stuff in the construction industry. He was asking, what are other major countries doing for their economies along the lines of what you've talked about this morning?
Well, I think pretty much everyone is trying to do whatever they can. We have some luxury of being a very large economy, very highly regarded credit, and an ability to raise capital in markets at relatively low costs. And that's allowed us to be pretty front forward in terms of our engagement and our relief. But countries across the world are all trying to think about how to react and respond. It's very interesting, if you look at Europe, just within Europe, there have been a diversity of responses and a diversity of outcomes. We're trying to understand and learn those things. And as we move forward, Europe is, I think, a couple of weeks ahead of us in terms of how the virus has progressed through their countries. We're going to pay attention to the different approaches and strategies for reopening the economy to see if any have really different realities. This issue and the policy in Spain about young people being outside the first part of the day and old people in the back part of the day, that's interesting. And I think as you look around, we're going to see a lot of interesting different approaches that we'll be able to take. I'd also say there's a lot of variation within the United States as well. I've been talking with folks in Atlanta. They've been surveying different city policies on how to reopen the economy. There's a lot of variation in that as well. And I think there's a lot that we'll be able to learn from those experiences as we move ahead.
Thank you. And Doctor, the next question comes from Christine Barney, the immediate past chair of this South Florida Business Council and a business leader in Miami-Dade County. She asked, you said your team is looking at what's working, what's enough. How much visibility will we have to seeing that data and information when you all assemble it? And has the Fed changed any of its communication methods during this pandemic?
So the Fed has been, to the second question, I think the answer is a little, but not really, in the sense that, you know, me and my colleagues have been pretty front forward about being out in the public, doing these sorts of webinars. You know, I've tried very hard to be very visibly engaged with our constituents across the Southeast, and that's going to continue. I'm doing a few more because it's easier to schedule them when you don't have to get on a plane and take the 5 hours to travel. But we're going to continue to do those things. In terms of the tools that we have, I would just tell you, you know, the Fed of Atlanta has about 10 years ago started doing a lot more in terms of surveying of businesses to see their expectations and their understanding of things. And so I would encourage everyone, I think there's going to be a slide on this at the end, but if you want to jot down a note, just go to our website, get on our mailing list. We have a weekly newsletter and a monthly newsletter that gives you information about the surveys that we're doing. And I will tell you, in many of these surveys, we are adding questions on a regular basis based on what's happening in real time. So there is always new and time relevant information. Another thing I would say is we've actually added a survey just recently, and there you see the information on how to keep in touch with us. But we've actually just added a survey where we're surveying businesses and nonprofits in low and moderate income communities, because we know those communities are places where families have less savings and where businesses are actually more on the edge in terms of the amount of available capital they have. We just released earlier this week the results of that. We contacted over 4,000 organizations, and there's some really interesting information there about what businesses are experiencing and what nonprofits are experiencing, and also how long they think it'll take before their communities get back to normal. So we're going to continue to do those things. I would say, please plug into us and make sure as much as possible that you have the time and the opportunity to review the things that we're doing.
Great. Next question comes in. We have a lot of local government and elected officials on this call. And the question comes in, can you provide any specific advice on what local governments should do relative to programs on a hyper-local level? For example, local governments have set up similar loan programs. Are these helpful? And if so, are there certain aspects that local government should focus on that would help the federal efforts to support small businesses in our communities?
So it's a really hard question. I think at a very high level, are they helpful? Yes. And local government can really help reduce the burdens. I was on a call late last week and was talking, I heard from some cities who said they're deferring business tax payments, for example, for 6 months or something like that. Those sorts of things all matter because in this time, you know, every dollar counts. And so everything that can be done is going to be useful. The thing that makes it hard is that there are so many cities that have so many different economies that underlie them, have different dynamics of where the stresses are. And what is going to be most important is for local leaders to really appreciate the character of their local economy and really be able to dissect and understand which places or parts of the economy are likely to get or be able to participate in some of these relief programs, which ones are going to be more locked out and might need support, and then figure out if there are ways to get support to those segments and sectors. You know, in my view, I think what we want to try to do is make sure that we spread our relief as efficiently as possible to make sure that we get relief dollars to those organizations or proportionate to need. So that, there's been a number of reports in the PPP program about some of those funds going to businesses that have access to capital markets, because, and the real question about whether that they should be getting that when there are other companies that only have one avenue for relief. I think that local governments can be in that conversation and think about that.
Great, thank you. Next question comes from probably one of the most optimistic people in South Florida, our president of the and chair this year of the Greater Fort Lauderdale Chamber of Commerce, Bill Feinberg. Bill's question is, from my understanding, we need to use 75% of all PPP money within the 8-week period starting when it hits our account. Unfortunately, many companies may need more time or may need time just to restart and re-energize, so it may take longer to use all the funds properly and according to the guidelines. In your opinion, will they revise this to allow a little more time to use the money?
So I can't answer that directly, but what I would say is the experience thus far would be encouraging. All right, so I think about how our programs have evolved. The Main Street Lending Program, we have multiplied the number of term sheets as we've learned more about the distinct ways that firms are evaluated across sectors. The Municipal Lending Program or loan facility that we have, we've changed the terms on that as we got feedback from governments and public officials about what was really going to be needed. And the SBA has actually evolved in terms of how they've laid out the rules and regulations for the program. So I would say, if they, to the extent that they hear about this and understand it, I'd be encouraged to think that they'll be wanting to respond, because putting sanctions on businesses at this time for those sorts of reasons, I think would be just counterproductive to what our real objective is. So I'm optimistic that they will respond appropriately.
Well, I tell you, using the words encourage and optimism with someone like Bill Feinberg means yes. So appreciate that answer. Next question comes in from Keith Larson and is asking, and folks, we have about 4 questions left, and I think we have about 10 minutes left. So we'll try to get through these last 4 if we can. All good questions. Yeah, I tell you, all good questions. So what are you seeing in terms of liquidity with banks and non-banks? Some non-banks are facing margin calls, and how worried are you about liquidity with non-banks? And is the Fed looking to provide any more relief or any relief to non-banks who don't have access to the Federal Reserve discount window? Any thoughts on that, Doctor?
Well, this is a hard question because, we have the ability to have the discount window relationship with banks precisely because they have a banking charter. And that charter has to mean something, and it provides that kind of support. So we're going to talk to legislators and see what they think is the appropriate thing moving forward. We know that the banking industry, the banking sector is much more heavily and significantly capitalized than they were going into the Great Recession. And that's been a great help for us in terms of, that's one sector where we've been less concerned about real stress and reductions. The non-bank sector, that is an area where the business model itself is going to bring stresses. But we are frankly constrained in terms of what we can do on this. And we'll continue to have conversations with the policymakers really to see what is possible and what they want us to do moving forward.
Great. Next question comes from Dennis Grady, who is the president of the chamber in Palm Beach, a great partner with the other 2 chambers here in the South Florida Business Council. Dennis is asking, how much pressure are you anticipating from local and state governments as they continue to experience declining revenue from sales tax and other revenue streams? Can you expand on that?
So, we get pressure all the time, but what I would say is this. These programs are stood up in ways that mean that there are not unlimited funds, right? And we have been constrained by the Dodd-Frank Act to be able to provide liquidity only at levels that are proportionate to the amount of backstop that the Treasury Department gives in terms of risk capital, right? And so the negotiation happens between the Federal Reserve and the Treasury. We come up with an agreement on how much capital is going to be available, and that multiplies up to a level of funding that's available for whatever facilities we have stood up. So once we get to those maximums, there's really not going to be a lot more we can do from a legal perspective, and unless we get authorized from the Treasury and from the Congress to be able to do more. So I do want to just emphasize that all of these facilities are stood up in ways that put real constraints on what we can do, and we'll act up to the limit of the law, but we won't go beyond that without being authorized.
Great, thank you. Next question comes in from a longtime banker in South Florida, Keith Costello, been involved in numerous banks, very successful banker here. He asked, the Atlanta region banks were hit particularly hard during the 2008-2009 crisis with a high number of bank failures. How do you see the strength of the banks in the region as compared to the last crisis? So compare the banks today in 2020 versus the banks in 2008, 2009. Comment on that?
Yeah, it's night and day. And I would say when I got here, our team had already begun working with the local banks in the 6th District in a very different way, having much more pointed conversations, being much more proactive, being much more transparent on concerns that we were having about potential increases in exposures to particular segments of the market that might be risky. And by and large, the banks in the district have responded in a very positive way. And as a consequence, they're much, much stronger. We have not seen a cascade of bank failures coming into this. You've heard very little discussion about any possibility of the need for something like a TARP program. And I think part of that is because of the new regulatory structure and the new relationship that we have with our banks to try to make sure that those exposures are not as significant. Another thing I would say on this is that, I said this in my opening remarks, we were looking for risks. We were looking for the buildup of risks in many, many parts of the district, and we weren't seeing them, which also suggests that the likelihood that banks would immediately be exposed to a bunch of troubled assets was going to be much lower. Now, the longer this goes, the more the businesses have distress, the harder it's going to get. Like, I understand that. But for now, banks have gone into this in a much, much stronger position.
Let me get back to we'll go to one last question before we wrap up. And it's from Janet Granger, and she's asking, do you see good coordination of data across the various private and public sector involving government functions and organizations? And is that data allowing us to see if things are opening up too soon, things are going too slow or too quick? What are your thoughts on that coordination of data across the public and private sector?
Well, I think the data that we're getting is what we're getting. And, there's tremendous variation in its quality across the country. Part of this is just, do we have enough kits to test people to really have confidence that we know everything that's going on in a particular area? Part of it is the type of information we're trying to gather is actually quite different than what is typical in many of these standard data issues. But what I would say is that when we learn things, we tell everybody. And we've not had any different experiences with our business partners or our government partners. And I just want to say thank you to all of you who have engaged with us, because I've been asking fairly pointed questions that can delve into some proprietary issues, and people have been fully transparent and open, and I really appreciate that. It helps us do our job a lot better and make sure that we get our policies oriented and focused in ways that maximize their impact and their relief. So we're going to continue to do those things. We're going to continue to collect data. I think as we move forward, our ability to collect data and the type of data we get will improve. But we're working as hard as we can to get as much information as we can so that our policies are working for everybody.
Well, listen, thank you, Dr. Bostic. And I will tell you, that's one of the most informative webinars I have been on since we've had this 7-week downturn. So thank you so much. And I know with just all the activity I'm seeing with the comments in the chat room, everybody has absolutely loved your presentation. And you certainly made Harvard, Stanford, and USC proud this morning.
Oh, very good. One day I might get to Notre Dame. I'm not sure I'm going to put on the jersey, but I'll go and cheer them on for something.
Absolutely. Listen, let me, at this point in time, before I turn it over to Adam Spiegel, just to make a few comments as our sponsor, I want to once again just recognize Alfred Sanchez, Dennis Grady, and Dan Lindblade. These three chamber leaders have done such a spectacular job during this downturn, keeping everybody informed, in the loop, and as you've heard this morning, staying connected with Dr. Bostic and his team, making sure the information flows both ways. And so, again, thank you to Alfred, Dennis, and Dan. With that, let me introduce Adam Spiegel, who is with MBAF, partner here in the Fort Lauderdale office. So I believe the largest minority-owned CPA firm in the country, certainly in Florida, if not the country. Adam, would you care to share a few thoughts and words this morning?
Jack, thank you very much. On behalf of MBAF, I'd like to thank all of you, especially Dr. Bostic, for joining us this morning. MBAF is a full-service public accounting practice providing a wide array of compliance and planning services, including traditional auditing, tax, litigation, and valuation, as well as technology and other consulting services to domestic and international for-profit and nonprofit clientele. We were recently awarded the 36th largest firm ranked by revenues in the country by Inside Public Accounting, as well as one of the best places to work from Accounting Today and the South Florida Business Journal. Today, we're discussing our future at a time when so much is unknown. While this pandemic is unprecedented in many ways, all of us have faced levels of uncertainty before. Whether it was the economic uncertainty brought by the stock market crash of 2008, or the oil crisis in 1973, or perhaps the personal uncertainty of risking everything to start a new business or move to a new job or location for your career. There's another name for these times of tremendous uncertainties: defining moments. Because the decisions made during these times of crisis forever plot the course of our future. So when you feel that uncertainty once again, know that it also brings lots of opportunity. At MBAF, we've weathered these times of uncertainty as a company with our clients and communities. Over 50 years ago, MBAF was established with a vision of helping other businesses achieve their financial goals. We have experienced many changes over those decades, including technology booms and some economic busts. As we have found ways to overcome those challenges, we also helped our clients, as we are doing now, when so many questions have arisen around new programs designed to help fellow businesses survive to once again thrive. We at MBAF stand by the South Florida Business Council, ready to help the community overcome and define this moment together. Many of you joining us today are business leaders who will be essential to the recovery our guest speaker addressed today. And MBAF is proud to support the South Florida Business Council and its members throughout this journey ahead of us. Thank you again for joining us, and I hope you enjoyed today's program.
Thank you, Adam, and thank you to MBAF for that sponsorship. And just in closing, again, thank you to Dr. Raphael Bostic and to the Federal Reserve. An incredibly informative morning. Thank you to our chambers working so well together and under the umbrella of the South Florida Business Council. And please stay healthy, stay safe, be well, and most importantly, be good to each other out there. And we'll all be back together building commerce and growing businesses very soon. Dr. Bostic, have a wonderful morning. And I believe this will conclude our South Florida Business Council webinar. Thank you all.